All right, Itay, it's good to see you, my man. Are you excited for today?
Super excited. It's been an eventful month, but to be fair, all of 2022 has been pretty eventful.
It has been a good year. And for everybody that is tuning in today, we're going to get to talk about a few very interesting things. The first being our Fed pivot fake out, and then we're going to talk about some prior Fed pivots, and lastly close with a short-term outlook on the markets. And really, the key person here today is Itay, our CIO here at Equi. So Itay, I'm going to turn this over to you. You're the one that's guiding the ship, and I'm just going to sit here, ask some questions, and help you explain some of the things that we don't fully understand. How does that sound?
Sounds great. Looking forward to it. And
Cool.
today will be a fun one.
All right, I'm excited. Let's do it.
All right, let me share my screen. And as long as that's going well. So we are Equi, making elite investing accessible. If you're watching this in the app, that's even better. That means that our uploads ability into the app is improving. Okay. Market update, September 8th, 2022. And let's talk a little bit about what we talked from last time. So a month ago, we made this update, talked about a 14% rally. And again, the question was, is this a bear market rally? This is what we said last month. And our conclusion was most likely, yes, one of those bear market rallies. Market continue higher about 100 points into the, maybe 150 points into the 4,300 area and failed. And why did it fail? So as we explained last month, we talked about this notion that the market believed there was a pivot being priced in by the Fed, meaning that the Fed is no longer going to be as hawkish, is no longer going to be as aggressive when it comes to interest rate increases or quantitative tightening, and really started pricing that in June, and that accelerated after the Fed meeting in July, getting into August. We were watching the market really doing that until this peak. There was a little bit of a sell-off, and then in this little arrow, that's when Jackson Hole, Wyoming took place. In the last month call, we stressed that it will be very important to watch Jackson Hole to see whether or not the Fed is really going to pivot the way the market thought, or the Fed is going to tell the market, no, we're not pivoting, and really basically telling the market, you're wrong. It was an unusually short speech. It was just about 8 minutes. And during that speech, Powell was as non-Fed speak as I've ever seen, right? Typically, the economy is falling because the economy is accelerating type of speak, which is very difficult to ascertain what the Fed's actually doing. In this case, he was, price stability is the most important thing. Inflation is just too high, and we're going to do whatever it takes to bring it down, even if it causes economic pain.
It sounded very hawkish, very direct to the point. He did not mince words in that call.
So the Fed made it very clear to the market, we want you to go down. The market took the hint and went down very aggressively. It was an over 8% price reversal in August, leading to more dramatic price action in 2022. And this is where we are today, right around the 4,000 level after a little bit of a rebound from these lows achieved just a few days ago. And this was what he was saying. Again, we use all our might, all our force to bring inflation down. And this is really what it comes down to. Prior to Powell's speech, the Fed fund futures here in white were basically saying that the Fed dot plot in green, meaning where the FOMC participants think interest rates are going to be. So in this case, in 2023, in this case, in 2024, the Fed was really saying no. I mean, the market was really saying, Fed, we don't believe you. You're going to cut rates in 23. You're not really going to do what you're saying you're going to do. And, market was just taking a very different view. Post Powell's speech, the market and the Fed dot plot are pretty much in line. So the market took the hint, and some of us traded that pretty well.
Are you trying to allude to something, Itay? Did you make some good moves in the portfolio?
our portfolio stood the very volatile month and eked out a little bit of a positive return. But that's besides the point. That was an inflection point that was worthy of a hedge.
Great job.
So, we covered this a little bit last time, and I still want to cover this again just to understand if the Fed does pivot, historically, is it positive or negative? And again, the example of the .com bear market, Fed fund futures in blue, S&P in red, markets sold off already when the Fed stopped hiking rates, and then continue to sell off as rates are dropping. So you have to remember that when the Fed actually drops rates, it's usually in a response to a recession. So it doesn't necessarily mean that the market just moves up on that, right? It's the anticipation of that may cause the market to move.
And Itay, the picture of Jay Powell, is that just going to find its way into every single future presentation that we have?
It's gotta, right?
I think so. Okay, let's go back to talking about history and charts.
Sure. So 05 to 2010, very similar story. Fed funds futures start getting cut, markets start dropping as the Fed drops rates, and even faster panic towards the zero line, so did the market. And then eventually the market started stabilizing. So a Fed pivot is not necessarily what you want to see, because that implies that you're not having a soft landing. You may be having a hard landing and a real recession. And that's something that we're all going to be watching for in 2023, where this is going to become a lot more relevant. The 1970s example is different, because the market literally just went in the direction of the Fed funds future. Some argue that the 1970s may be a more relevant example given the inflationary picture and really the stagflation we're experiencing. So in the 1970s, that's the Fed fund rate inverted. And then that's the S&P 500. Rates go higher, S&P goes lower, rates go lower, S&P goes higher. That was a very easy trading environment. Really, you just follow the Fed fund rate, which was telegraphed in advance in order to figure out what the market would do for that entire decade.
Great.
So the really big story is the quantitative tightening for September. And why is that? Because quantitative tightening this month is doubling, and already has, in fact. So when you look at the S&P 500 in red, this is as of yesterday, September 7th, versus the balance sheet of the Fed, which is here in blue. And the dashed line is the projection. So right now we're in this quantitative tightening. We've seen a very strong correlation between the performance of asset classes and what the Fed has done. This dashed line here is the first QT. So in 2018, the Fed started the QT1, and this was their projection. So they were looking to really diminish the balance sheet quite a bit. But in December, they stopped. They stopped because the market was selling off 20% plus, and then markets eventually recovered. And then even before COVID, they already started a version of QE4 because there were problems with money market funds and other things like that. So this projection, as history shows us, this projection currently doesn't necessarily mean that that's what's going to play out. Yeah. This is the current Fed projection for what they think they're going to do.
And let's just talk about it again, QT meaning taking money out of the system. So, the Fed receives a bunch of these bonds, and as the principal payments come due, quantitative tightening just is a quick delete button out of the system once those once those principal payments come back to them. So we will see if that actually does hold up, or if we're going to see a similar type of thing where they have to hit the eject button on the QT.
That's exactly right. And, so far it's been fairly easy almost. Balance sheet is expanding, markets go up, balance sheets expanding aggressively, markets go up even more. Balance sheets contracting in anticipation of that happening, markets have been having a much more difficult time in 2022 versus 21 or even 20 as the Fed was expanding their monetary policy. And you can see that here, where you can really see that during periods of high QE, S&P returns have been substantially better than in periods where you have QT, in this case even negative. or QE removal after QE, and now that's the TBD period where in September, we are looking at $95 billion per month. And let's talk about this recession watch and the things we're looking for to determine whether or not we're going towards a recession. First off, if you're looking at leading economic earnings indicators, if you are excluding the PMI, which is manufacturing, that is fallen off a cliff recently, and earnings are starting to follow, or earning growth are starting to follow. So that's from Morgan Stanley. That's our first alarming recession indicator.
And Itay, remind me, non-PMI means what?
It's leading indicators that exclude the manufacturing. So
just a basket of leading indicators.
Yeah, it's just a basket of leading indicators.
Okay.
And this is your forward PE ratios right now. So forward PE has drastically fallen. If you're looking at the last 10 years, you could argue that it's actually cheap. You're standing below 15 on your forward PE, where, you know, just in late 2021, we were north of 25. So that's been a, you know, you could almost make the argument at this point that, well, so what, we get a recession, but that means that stocks are cheap and now is the time to buy, which historically is true during a recession. However, that doesn't necessarily take into account earnings revisions and earning deceleration from here. So if earnings are going to fall in the future and prices stay the same, this is not going to be as cheap as you see right now.
That makes sense.
It's price over earnings, right? So it's a multiple.
Correct. So then your PE could actually go up.
That's actually what happened in 08. That's exactly what happened in 08. And then it was a big spike. So on the housing sector, one of the most important key drivers of the economy, this is a sentiment index. Basically, when people are asked, are you planning to buy a home? Is now a good time to buy a home? And you can see how that improved from 2011, 2012, quite a bit. Then COVID happened, and then there was some rebound. And now we're at a very, very low level, which means that people are not planning on purchasing a home, or that's going to be reduced quite a bit. That's a key driver of economic activity, which with interest rates being so high, it's almost 6% for a 30-year fixed. It makes purchasing a home more difficult.
Itay, is there any kind of historical, almost like baseline or average of what home purchase sentiment index kind of stays at?
Yeah, I mean, you see it fluctuates in this case between 60 and 90, and we're getting close to the post-financial crisis levels of sentiment. So it's pretty negative. This obviously has, now this goes back to 1997. And that makes sense because this is the Goldman Sachs Housing Affordability Index. It's a combination of basically your salary versus the monthly payment and that monthly payment is derived from the price you're paying plus the interest rate on the home. So up until 2020, it was not too bad because, you know, prices were rising, but rates were so low. But now the combination of still high prices and very, very low, still high prices and very high interest rates.
Yeah, exactly.
Now, what's really worrying me is that we reached those levels in 05, 06 when home prices really went up and interest rates were also around 5 or 6%. We all know that ended pretty badly. So watching the housing market now, I think, is going to be key to understanding probabilities for a recession going forward.
Sounds good.
And of course, we have the yield curve. Right now, you're seeing the 2x10 yield curve, which is the 2-year treasury over the 10-year treasury. And there's a negative spread right now. So the dash line, the line here is the 0 line. And right now, the curve is inverted. This happened in 2006-07. This happened in 2000. This happened in 1989, 1990. And this also happened in 1981. Now, I don't think we're going to get an inversion like 1980 because the 10-year treasury is not in the double-digit zone like it was back then. So we're pretty much at the historical limits given where we are in interest rates. Usually when you start to steepen out, is when the recession hits, because the long bonds start appreciating and rates actually fall in the long run, because then the market's starting to anticipate the Fed rate cuts. So
And in this graph, Itay, is 10-year yield minus 2-year yield, correct?
that's right.
Okay.
That's right. So again, something very, very important to notice. Interesting trade too is you can actually play for the steepening, knowing that historically speaking, getting back to the steepening situation is very, very likely. So that's something that has a pretty good risk reward if you're that type of macro trader.
Ooh, that was one of those insights that you drop from time to time.
All right. So some good news. We do have easing of inflation or inflation expectations. Commodity prices have fallen sharply in August. And you can see the CPI versus the commodity year-over-year rate of change. So commodities do point to a lower CPI. I do think that next week, when we get the CPI data, it's probably going to come out lower, which should ease some pressures in the short run. However, the Fed made it very clear in Jackson Hole that even when CPI starts dropping, they're worried that they will ease or lower interest rates too quickly. In the 1970s, that's the mistake the Fed did. Initially, they raised interest rates. They saw inflation easing off a little bit, and then they dropped rates right away, and that led to much higher inflation. So Powell made it very clear that they want to learn from that mistake, and they're looking into keeping rates higher for longer, even if it causes economic pain, until they're very sure inflation's come down. And that's definitely something we should be aware of in the back of our minds. Small business price plans, that's also has a leading correlation to CPI, and that's also been falling. So again, good news on the inflationary front, or the likelihood that the peak of inflation is behind us is now very high.
Well, what would happen if when Europe goes through a really cold winter? Do you think that could throw a wrench into our plans?
Why do you steal the back end of the show? We have 10 slides on that.
We'll just have to cut that out. Okay, I got all excited. I didn't actually know what you had cooked up.
That's awesome. Okay, so let's talk about our short-term view. A lot of people have asked me, look, you're making calls on markets. You know, how does some of those get done? And let's talk about that short-term view. So there are some catalysts that we watch for. On September the 13th, as we well know, there's a CPI report that I think is going to be very important for the market. And then we have the quadruple expiration of options and futures on September the 16th. Now, those big option expirations, because the derivatives market became such a large part of the total markets, have become incredibly important for market direction and can act as catalysts on their own, just because of the amount of trading volume and hedging requirements that take place around those dates. And then we have the September FOMC rate decision that's most likely looking now like another 75 basis point rate hike, which is just, again, unbelievable. We live in truly historical times. So what we've been noticing, and this is something that is really important to realize, is the market is here in yellow versus the put to call ratio in blue. What we've noticed is that when puts are very high, everybody wants to get puts because the market's going lower. That tends to coincide with market bottoms because the market becomes overhedged, and then it's difficult for the market to go lower. And that triggers oftentimes a short squeeze because then eventually all these puts have to be sold, and that puts upside pressure on the market. I'm not going to go into the actual mechanics of why that happens, but it happens very, very frequently. What we've also seen is that the recent tops, so in a bull market, this can stay for a very long time. This can stay, you know, in one side or another. But in a volatile market like what we've seen in 2022, this is March, and this was the recent August top, we've seen that there was almost no put protection. So when there's no put protection, it can allow the market to go lower. It allows the market to go lower because the participants are not hedged enough, so they need to either open new hedge positions, which is a sell order effectively, or they need to actually sell. And that's really the dynamic that moves markets around, particularly in bear markets. So as of recent, into this low, we've seen a big grab for puts again. And that could, at least in the short run, cause another one of these bear market bounces we've seen a bunch of this year. We've also seen bearish sentiment pick up quite a bit, and that really matches what we're seeing in the options market data. So the logic says that too much bearishness is a contrarian indicator, because that means that everybody that wants to sell already sold, at least in the short run. So let's talk about that open interest data, looking at the expiration. We've seen that there's a lot of interest at 390 or 3,900 on the S&P. And we've seen that number last week hold, this week and last week hold 3 times, including on very bad news. On Friday, we got the news that Russia is closing Nord Stream 1 due to a mechanical failure. Markets reversed after the jobs report from up to down, closed around that 3,900. And then we couldn't really breach below it because there's already so many puts there. Every time we get there, participants that hold that put likely are monetizing some of them. And then that acts as a buy order, and that puts upside pressure on the market. And that's probably why that area has been supported. So as a result,
so the way to read this is that the negative absolute gamma is basically the demand for the demand at that number. So at 3,900, we're saying this big bar chart down means that there's a lot of buyers there. Correct?
Right. There's a lot of open interest there. So as long as that number holds, that basically keeps the market there and creates buying pressure. But if that number gives out, then all that becomes selling pressure and can accelerate the market to the downside. So areas of very large bars act many times as kind of like support for price or resistance for price when it comes from below. We notice that happening very, very frequently. So into this expiration, there's a lot of interest at 4,000. If 4,000 gives, we could see a pretty large move to the right until more interest builds on the upside. So there is a potential for a short squeeze. This is another way to look at it. You're seeing this, this basically buying and selling pressure. So you do see some resistance at 4,000, which is why the market has held that number 3 times in the last week or so and kind of like got there, fell off, got there, fell off. But we know that if it goes above it, we'd probably have a good amount of upside because there's not too much resistance above it for now. And then that's the reason 3,900 has held so well. There's just a ton of interest there on the put side, and we've seen 3-4 attempts to get below it that failed. So we've seen this play out before. What you're seeing here is 120-minute chart. So each bar is 120 minutes going back here into January. So January, February, March, this is where we currently are. These boxes represent some of these opportunities where we've seen these type of pressures in the past. And in these boxes is when we place hedges, when hedges were cheaper, as you see in that put to call ratio, when there's less demand for puts, tends to be around the tops this year. And that also makes puts a lot cheaper. So we've used those market positioning situations to put on positions in our hedge book to offset market risk for the broader portfolio. That's done very well. We've done it here, here, here. Here, that was actually an overshoot. So we did this around the 4,000, 4,100 level as the market actually overshot. And now we're looking at this box potential, thinking the market is likely going to get there ahead of expiration as another very good place to add on to hedges for the portfolio.
Good insights. Thank you.
All right. So keeping that in mind, that's a very short-term outlook. The longer-term risk remains very high. So what we're looking here is the S&P 500 in white versus TLT, which is an ETF that tracks the US Treasury market. It's a 20-year, so it's a blend of the 10 and 30-year. And we've seen that the market's been correlated with it all year, which is why the 60-40 hasn't worked at all, because bonds have been very correlated with stocks and really moving in the same direction. And it made new lows for the year. And that means that interest rates have made new highs for the year. And that's still of a concern, because even though we're bouncing, this may be a technical bounce. We've seen that every time in the year when we did diverge away, we came right back in. So that's something to keep in mind. The risks are still high. The dollar is telling us the same story, where you're looking at the dollar euro here, really euro USD. The Japanese yen would say the same thing. Japan, it's in its own can of worms, so I don't want to open that can of worms right now. The yen is really imploding because of divergent policies, right? The Bank of Japan is still easing versus the rest of the world that's tightening. But Europe's a better example because they're tightening. They actually raised interest rates 75 bips today.
Oh, it was a 75 bip hike.
Yeah, they raised 75 bips today, and they're looking to do another 75 bips, but they're not on par with the Fed, which is why the euro is 0.9999. Nice little number there. But as long as the dollar continues to appreciate, that's usually not good for the global economy, because it acts as a liquidity suck from the rest of the world. So another thing we look for in the macro front, and as we watch the euro make new lows, dollar makes new highs, that's just something to know in the macro front.
And are people rotating out of the euro just because the spread is higher to go into treasuries? Is that why we're seeing this depreciation in the euro?
I mean, that's a part of it. You also have much higher interest rates in the US. That's a good point. But also there's more of a need to buy dollars to pay for all the loans that are dollar based, right? So going back to that example, if a Norwegian company makes a deal with a British company to do an offshore oil rig, they're going to probably borrow the money in dollars, and they price their commodities in dollars. So when the dollar rises during a period like this, it acts as a global QT, really.
Got it. And didn't China and Russia just agree to start trading directly in both ruble and yuan for their resources?
Yeah, they're definitely trying, and they have been for a while. They're trying to undermine the dollar's status as a global reserve currency.
Yeah, and I know we talked about that before, so doesn't come as a surprise, but I just saw another thing on that recently.
Yeah. And the war in Ukraine and the sanctions are not helping that situation. So again, 2022 has turned out to be a very turbulent year, and we're, as we watch dollar makes new highs and we watch interest rates, that's just something to be aware of in managing risk. So let's talk about the European gas issue. We've seen power prices rise quite a bit in different European countries, energy bills, electricity, and things like that. And there's a lot of worry. And this is really the reason. When you're looking at Europe as a whole, the increase in energy costs between 2021 and 2023 could reach 2 trillion euros. And that is a huge number out of their GDP that could act as a huge catalyst for not even a recession, but almost depressionary type pressures.
Mm-hmm.
So this is a time of a squeeze and high inflation already.
So there's a million questions I want to ask. You just have to tell me what to pause, because I'm guessing you probably have a lot of other things you want to say on this.
Yeah, I mean, we can talk about each slide as it goes. This is really where it comes down to when you're looking at the average household prices for electricity and gas. And it really comes down to, how is the EU going to handle that? Are they going to subsidize the energy bills, which they have been doing for households, at least in a lot of countries, but they haven't necessarily been doing it for businesses. I know Germany announced a plan to fund 65 billion and try to help their businesses. And they have some random plan to tax extra profits the energy companies are going to make, but it's still to be determined if they're really going to increase their margins that much, because their supply side also could get squeezed. So it really depends on multiple factors, but so far there's a lot of pressure on Europe when it comes down to energy.
Got it.
And this is the UK, for example. The forecast now is, imagine your bill from £1,000 goes up to £6,000.
That's unbelievable.
What does that do to discretionary spending, recession? And this is at a time.
What does that do to all the businesses that are already operating on a razor thin margin? Like this, to me, this would tell me that this is a shutdown mode.
It could be there, and we already saw some metals worker in Germany shutting down, some aluminum and things like that. And really, the issue is unlike COVID, when you could shut down the economy and give people money to stay home, it's much more difficult to do that when the EU has 10% inflation and the ECB goes from QE to not QE and interest rate increases. So your margin for being able to do that kind of stuff is really diminished, which is why the risks are very high going forward. But on the positive side, the Germans being told that gas is going to be a big problem have dramatically reduced consumption, right? They're not turning the heating or cooling in government buildings. They're closing public pools. They're told to wear a big jumpsuit in the house, or we'll do that in the winter. They're told not to raise the heat over, I think, 62 degrees or something like that. That's kind of like where they're going to keep it. And we've seen a big reduction this summer, minus 20% in consumption, which could help a lot. But even if it does, into the following year, they're going to have absolutely no gas in storage. So it all depends on how long this lasts, and are they really going to be able to withstand that? And this is the sources currently in Germany, and you see natural gas is not as much, but it's more impactful than you think, just because that's the marginal usage that's in there. So they're looking into reducing nuclear, and it looks like right now they're gonna at least keep what they have online until they figure it out.
Got it. You were saying they're planning on reducing their nuclear footprint in general, but they're going to keep it now.
Yeah, they were looking into doing that.
Wouldn't this mean the time where this is like nuclear's time to shine almost?
Yeah, but there are a lot of environmental concerns about nuclear, and especially some of these reactors being really aging.
Sure.
And this is really really what it comes down to. So this is basically the gas deliveries that you can see between Russia and the EU. So there's a few ways that we're doing it. There's the Russia-Ukraine flow, which, believe it or not, is still going on. Even after Russia invaded the Ukraine, Russian gas was still transiting the Ukraine uninterrupted, and still is to a point, while the war is raging, which is just mind-boggling, right?
Why is that happening?
Ukraine was still making money off of it, and both Russia and Ukraine want to fund the war, so they were still allowing Russian gas to transit the Ukraine while both were actually making money while fighting each other. So that's something to realize there. There's the Turkey, Bulgaria, and then the biggest one, of course, is Nord Stream. And right now we are falling to just about zero. So it started out when last week Russia said that there's mechanical issues in Nord Stream 1, and now they really admitted that the only reason it's shut down is because they want Western sanctions to be taken out, and they're going to keep it shut down until it is. And this is really the problem chart. What you're seeing here is the total EU's storage for gas. And it's very cyclical, right? It rises in the summer because there's a lot less usage of gas, and then there's a big drawdown in the winter. And then it rises, and then there's a drawdown. So in 21, we started the year slightly less storage than what it is now, which was relatively low. And then now it's still kind of low, but not as low as last year. And we know that the heating season is going to start in a few months, and we know there's going to be a drawdown coming. The difference is in prior years, if you go back to this chart, you're still getting all this gas all year long. However, you're getting into the drawdown period without getting any gas. So this is the zero line. You already are getting towards the 200 mark, 200 to 300 mark before. The big question is, how low do we go, and do we really approach zero, and what does that do to electricity prices? A lot of it depends on how cold the winter is going to look like. Are they really going to be able to reduce demand? There's just a lot of uncertainties, and this is why those two things have been correlated very much. This is really the VIX for in purple is the euro, and then in yellow is credit protection, credit risk for euro. So we're now at spike highs, which is really close to where we were in peak COVID here, and both on credit and euro. Euro is more volatile. Sometimes you have these quick spikes, and then maybe around some elections and things like that. Credit protection a little bit less so, but now we're seeing a big spike in both credit protection and Eurovix. And what's interesting is that the V2X, which is equities in Europe, are not really as nervous as credit protection in Europe. Again, we're seeing a divergence where equities are more positive and more optimistic, let's say, than what credit protection and currency protection, more professional traders are. And that's heading into this winter season. So a lot of risks. I do think that the key to 2022 remains capital preservation, really avoiding large drawdowns, making sure that the portfolio is protected during these kind of times so you can compound from a higher place when it's safer to take more risk in the portfolio, or if equities become cheaper, or whatever it is, or diversify through different strategies the way we do at Equi. But remember, capital preservation is key. When you lose half of your money, like you do in 08, 09, and in a severe bear market, which this is still to be determined if it ends up that way. Now we're down close to 20%. Does it become 40? Does it become 50? Does it end here? Nobody really knows. But the only thing we do know is if you have $100 and now it's down to 50, you need to make 100% to get it back.
That's right. That's why rule number 1 for Buffett, never lose money. Rule number 2, never lose money.
Yeah, and this is really it for today. So if you have any questions, feel free to email us, or
we're just founders at Equi.com. You can also visit Equi.com. And if you mention that you found us here, we could try to bump you up the wait list. We've already got about 3,000 people on it. So you get a little credibility for having showed up here.
Awesome.
Well, great job, Itay. Thank you so much for making time. And we'll see you again next month.
See you again next month.
Take care.
Bye-bye.